All right, let's cut right to it. Imagine finding a hidden cheat code for your taxes, a way to significantly lower your annual bill. And not by dodging responsibilities, no, but just by simply knowing the rules better than anyone else. That's precisely what we're diving into today. These powerful, often overlooked tax adjustments that can put more money back into your pocket.
Welcome back to Deep Dive. And yeah, today we're dissecting a really critical area of tax planning. These things called adjustments to your adjusted gross income, or AGI. And these aren't just, minor tweaks on your final tax form. They are fundamental deductions. They directly reduce the amount of income the government can actually tax you on. They're often called above-the-line deductions
Yeah.
because, well, that's where they sit on the tax form, right near the top.
Which makes them incredibly impactful.
Exactly. And that position above the line, that's absolutely key because your AGI isn't just some number on a form, right? It's often the foundational figure for so many other tax calculations limitations. That's it. A lower AGI can ripple outwards. It can affect your eligibility for certain tax credits, how other benefits phase out, even how some deductions or investment income might be treated down the line.
So, our mission with this deep dive really is to reveal these potent above the line opportunities, the ones that can make a real tangible difference for you. We're talking immediate savings, yeah, but also your long term financial health, and honestly, maybe just a bit more peace of mind come tax time.
Absolutely. And when we talk about adjustments in tax terms, yes, they're known as above-the-line deductions. But you might also hear them called, more precisely, deductions to arrive at adjusted gross income.
Mm.
That specific terminology, it's pretty common in the professional tax world, especially if you're looking into things like the CPA exam,
Hmm.
where understanding that tax code hierarchy is just paramount.
Why that specific phrasing, though? Deductions to arrive at.
Well, it really emphasizes their unique position. See, unlike itemized deductions, which, you only take if they add up to more than your standard deduction, these adjustments reduce your income before you even get to that choice. They really do build the foundation of your whole tax picture.
Precisely. Think of it like, yeah, building the bedrock. If your AGI is lower, it can unlock more tax advantages later on, or maybe stop certain credits from phasing out that you might otherwise lose. It's that upstream impact. That's what makes them so powerful. It's not just about taking a deduction, it's about strategically optimizing your entire tax profile.
Exactly. It's like having a special lever, one that just moves your entire tax base down a notch. So any subsequent calculations that rely on that AGI number, things like limitations on medical expense deductions or maybe certain investment interest expenses, they'll then be based on that lower figure, which could potentially save you money in multiple places, not just one.
Okay, so with that crucial understanding locked in, let's give everyone a preview of the landscape we're about to explore. Because we're going to dive into 12 specific types of adjustments, the ones explicitly covered in our source material here. And they're diverse, really. They touch on everything from your job to your savings, even your self-employment income.
Right. We'll be covering educator expenses, traditional IRA contributions, student loan interest, health savings account deductions. Also, moving expenses, though, we'll see. Those are very limited now, pretty much just military personnel.
Right.
Then there's the deductible part of self-employment tax, self-employed health insurance, self-employed retirement contributions, penalty on early withdrawal of savings, alimony paid with a really crucial pre-2019 date we need to stress, and finally, attorney fees in certain discrimination and whistleblower cases.
Yeah, that's quite a list. Okay, let's unpack this one by one then, because like we said, each one is a potential opportunity for you to keep more of what you've earned. Let's start with some of the more common adjustments, things many taxpayers might actually run into.
Sounds good. First on our list, educator expenses. This adjustment, it basically acknowledges those often unseen, out-of-pocket costs that so many dedicated educators pay to make their classrooms better.
Yeah, you hear about teachers buying supplies all the time, so who qualifies? Is it any teacher?
It's defined pretty precisely. An eligible educator includes kindergarten through grade 12 teachers, instructors, counselors, principals, or even aides. And the key is they have to work in a school for at least 900 hours during a school year. So it's not for like a casual volunteer. It's for active professionals in education.
900 hours. Okay, that's a real commitment. So for those eligible folks, what exactly counts as a qualified expense? Is it just, pencils and paper?
It goes quite a bit deeper than just basic supplies, actually.
Hmm.
Qualified expenses are those considered ordinary and necessary for the classroom. Now, ordinary just means it's common, accepted in the education field, the stuff other educators typically buy. And necessary means it's helpful and appropriate for their job, though maybe not something the school required them to buy.
Okay, so give me some examples.
Sure, it covers a broad range. Books, general supplies, equipment. And interestingly, in recent years, this has expanded to explicitly include things like personal protective equipment, computer equipment, software, and services, plus any other classroom materials used directly for students, and also costs for professional development, like courses they take to maintain or improve their teaching skills.
So if a teacher buys, say, some special educational apps for the classroom tablets, that could count.
The educational apps, absolutely, if they directly benefit the students or the classroom environment. Now, things for the teacher's personal use, even if helpful, might be harder to justify as classroom materials. It's generally focused on student benefit.
Gotcha. And what doesn't qualify? Are there specific exclusions?
Yes, definitely. Expenses for homeschooling are explicitly out. Also, non-athletic supplies for health or physical education courses. So, a science teacher buying lab gear, fine. A gym teacher buying, I don't know, athletic tape, probably fine. But maybe not, say, specialized nutrition supplements, even if they discuss nutrition.
That distinction makes sense. Now, I know there are also some reduction requirements. What if a teacher gets reimbursed for some of these costs or uses tax-free money somehow?
That's a critical point, yeah. Your qualified expenses, the amount you can deduct, has to be reduced by certain tax-free amounts you might have received that relate to those expenses. This could be things like excludable interest from U.S. savings bonds if you use them for education costs, or maybe non-taxable earnings from a 529 plan or a Coverdell account. Basically, if you already got a tax break on the money used for the expense, you can't double dip and take the deduction too.
Makes sense, right? And any untaxed reimbursements you got from your school, say, that weren't already included on your W-2, those would also reduce your deductible amount.
Right, no double dipping. So what's the actual deduction limit here? How much can an educator take? There's a cap. It's up to $300 per eligible educator per year. Now, if you have spouses filing jointly, and both are eligible educators, the maximum deduction for the couple is $600. But, and this is important, neither spouse can deduct more than $300 of their own qualified expenses. So one spouse can't use the other's unused limit, basically. Still, it's a direct above-the-line saving, a small but valuable benefit acknowledging what educators put into their classrooms.
Definitely a good one for hardworking educators. Okay, next up is something I bet many listeners are familiar with, especially those building careers. Student loan interest expense, this can be a big help, right?
Oh, absolutely. This adjustment offers significant relief for folks managing education debt. It's a direct reduction to their taxable income. The maximum amount you can deduct for student loan interest is limited, though. It's capped at $2,500 annually. But, and this is a big but, it's not a flat $2,500 for everyone. It's subject to income phase-outs.
Ah, the phase-outs. So the higher your income, the less you can claim. Tell us about those income limits for 2023. Where do they kick in?
Okay, so for 2023, the deduction starts to gradually reduce for unmarried taxpayers once their AGI hits $75,000. It phases out completely once your AGI is $90,000 or more. For those married filing jointly, the AGI phase-out range is higher. It starts at $155,000 and goes up to $185,000. Above $185,000, the deduction is gone completely. So yeah, if you're single with an AGI of, say, $82,500, you're exactly halfway through that phase-out range. You'd only have to deduct half the max, so $1,250.
That's a relatively narrow window where it scales down. Are there other key rules about who can actually claim this deduction?
Yes, a few critical ones that often trip people up. First, if you're married, you must file jointly. No married filing separately for this one. Second, a dependent can't claim the adjustment. It's meant for the person primarily responsible for the loan. And third, building on that, the taxpayer claiming the deduction must be legally obligated to pay the loan.
Okay, that legally obligated part seems important. What if parents are helping out?
That's a super common question. If parents are making payments on their child's student loan, the parents typically do not qualify for the deduction. Why? Because usually the child is the one legally obligated on the loan documents, even if the parents are footing the bill. The deduction follows the legal obligation.
That's a crucial distinction. It's really about the debt belonging to the person responsible for it, not just whoever pays.
Exactly. And one more thing. The interest must be on loans that were incurred solely for qualified education expenses. This means the loan itself had to be for things like tuition, fees, room and board, books, supplies at an eligible school. You can't just take out, say, a home equity loan, use some of it for tuition, and then deduct the interest. The loan has to be specifically for education from the start.
Got it. Very targeted relief for education debt. Okay, moving on, we have a simpler one. The penalty on early withdrawal of savings. Sounds painful, but at least there's a deduction.
Yeah, this one's pretty straightforward. It covers those penalties banks charge if you pull money out too early from things like certificates of deposit, CDs, or other time savings accounts. The logic behind why it's deductible is sound, actually. The penalty you pay, it's basically considered interest you forfeited. You likely already paid tax on the interest that CD earned along the way, or it was reported as income to you. So letting you deduct the penalty kind of offsets that income you technically didn't get to keep. It balances things out.
So it's a direct deduction for a specific, maybe unexpected financial event. Good to know there's a small silver lining if you get hit with one of those penalties.
Exactly. It just softens the blow a little. Okay, now let's shift gears to a really significant area for long-term planning. Individual retirement accounts, or IRAs. Understanding these is just huge.
Ah, yes, IRAs. We hear about the different types. Deductible, traditional, Roth, non-deductible, traditional. Honestly, just the names can be a bit confusing sometimes.
They definitely can be. But figuring out the differences is crucial because each one plays a slightly different role in your financial strategy. Let's start with some general contribution rules that apply to all these IRA types, okay?
Okay, the basics first.
Right. For 2023, the absolute maximum you can contribute across all your IRAs combined, if you're under age 50, is the lesser of either your earned income for the year or $6,500. If you're married filing jointly, that's potentially $13,000 for the couple, but it's still $6,500 per person.
And then there's the catch-up for older folks, right?
Exactly. If you're age 50 or over by the end of the year, you can contribute an extra $1,000. So the limit becomes $7,500 for an individual or $15,000 for a married couple, $7,500 each. And remember, that's a combined limit. You can split it between a traditional and a Roth, maybe, but the total can't exceed that $6,500 or $7,500 threshold per person. That's a common mistake people make.
Good clarification. It's not $6,500 per type of IRA. It's $6,500 total across all your IRAs. Now, what counts as earned income for this? Is it just salary?
Earned income is specific here. It includes things like salary, wages, commissions, bonuses, tips, also net earnings from self-employment. Interestingly, for divorce agreements from before 2019, alimony received also counted. And certain taxable non-tuition fellowships count too. What doesn't count is passive stuff. Interest, dividends, annuity income, pensions, and crucially, alimony from divorce agreements executed after December 31st, 2018 no longer counts as earned income for IRA contributions. That was a big change.
Wow, that 2018 cutoff date keeps popping up. That's a really significant change for people relying on alimony post-2018. And just quickly, isn't there also something called the Savers Credit, an extra bonus for contributing?
Yeah, that's a great point. The Retirement Savings Contribution Credit, or Savers Credit, it's an additional tax credit which is even better than a deduction for eligible lower and moderate income taxpayers who contribute to IRAs or employer plans. Yeah. Definitely something to look into if your income falls within certain limits.
Good tip. Okay, let's dive into the first type. The deductible traditional IRA. This is where the immediate tax break happens, right? The AGI adjustment.
This is the classic one, yes.
Yeah.
The core benefit, your contributions are subtracted directly from your gross income to arrive at your AGI. That's the above-the-line adjustment we're talking about.
Yeah.
Now, a key deadline here. The contribution for a given tax year has to be made by the tax return due date, usually April 15th of the next year. And crucially, filing an extension for your taxes does not extend this IRA contribution deadline. April 15th is firm for the prior year's contribution.
No procrastinating on that IRA contribution if you want the deduction for last year. Okay, so the money goes in tax deductible. What happens then? How does it grow? And when do you pay taxes?
Right. Once the money's in, the earnings, interest, dividends, capital gains, they accumulate tax deferred, meaning you don't pay taxes on the growth each year, which is a huge advantage. It lets your money compound faster. But when you eventually take distributions in retirement, both your original contributions, the principal, and all those accumulated earnings are taxed as ordinary income in the year you withdraw them.
So tax break now, pay taxes later. What about penalties if you take it out early?
Generally, yes. Withdrawals before age 59 and a half are usually subject to a 10% early withdrawal penalty on top of the regular income tax, unless you meet specific exceptions, like disability, certain medical expenses, or using up to $10,000 for a first-time home purchase.
And you can't just leave it in there forever, right? The government wants its tax eventually.
Correct. You have to start taking required minimum distributions, or RMDs. The rule now is you generally must start by April 1st of the year following the year you turn age 73. And failing to take your full RMD on time comes with a steep penalty, potentially 25% of the amount you should have withdrawn. So you definitely need to plan for RMDs in retirement.
Okay, so Tax deduction now, tax-deferred growth, taxable withdrawals later, RMDs eventually. Sounds straightforward, but I sense a complication coming. Doesn't it matter if you have a retirement plan at work?
Ah, yes. You've hit the big one. That's where the straightforward path gets. Well, less straightforward for many people. If you actively participate in an employer-sponsored retirement plan like a 401k, a 403b, a pension plan, then your ability to deduct your traditional IRA contribution might be limited or even eliminated based on your income.
Okay, so having a work plan can limit the IRA deduction. Give us those income phase-out ranges for 2023.
Sure. If you're an unmarried taxpayer and you are covered by a plan at work, the deduction starts phasing out if your modified AGI is between $73,000 and $83,000. Above $83,000, no deduction. If you're married filing jointly and at least one spouse is covered by a work plan, the phase-out range for the covered spouse is between $116,000 and $136,000. Above $136,000 AGI, that covered spouse generally gets no IRA deduction.
So if your income falls in those ranges, the deduction gets smaller and smaller until, poof, it's gone.
Exactly. It's a proportional phase-out. If you're halfway through the range, you lose half the deduction.
Okay, that covers individuals and couples where someone is in a plan. But what about the situation where one spouse is covered by a work plan, but the other spouse isn't? This always seems super confusing.
It is confusing, but it's a really important rule. There's a special, more generous rule for the spouse who is not an active participant. If a married taxpayer is not covered by a work plan, but their spouse is, the deduction for the non-covered spouse phases out based on different, much higher AGI limits. For 2023, if you're married filing jointly, the deduction for the non-covered spouse phases out between a couple's AGI of $218,000 and $228,000.
Whoa, wait. So the covered spouse starts losing their deduction way down at $116K AGI, but the non-covered spouse can potentially still get a full deduction all the way up to $218K AGI?
That's exactly right. It's designed to allow the spouse without access to a workplace plan to still save for retirement via a deductible IRA, even if the couple's income is fairly high. Now, if they're married filing separately, it's a different story. Then each spouse is pretty much subject to a very low $0 to $10,000 phase-out if either is covered by a plan. Filing separately really limits this.
Okay, this MFJ scenario with one covered spouse and one not, that needs a breakdown. You mentioned a chart. Let's walk through that. This seems key for couples planning together.
Absolutely. Let's use that summary chart logic.
Yeah.
Assume spouse 1 is covered by a work plan, ESRP. Spouse 2 is not. Both have earned income, filing jointly. Scenario 1. Their combined modified AGI is less than $116,000. Good news. Both spouse 1, the covered one, and spouse 2, the non-covered one, can take the full IRA deduction up to their limits.
Okay. Low income, both get the deduction. Makes sense.
Scenario 2. Combined AGI is between $116,000 and $136,000. Now, spouse 1's deduction starts to phase out proportionally because they're in that covered spouse range. But spouse 2, since they aren't covered by a work plan and the AGI is still below their special threshold, $218K, spouse 2 can still take the full deduction.
Interesting. So the covered spouse starts losing it, but the non-covered spouse is still fine.
Scenario 3. Combined AGI is between $136,100 and $217,999. Okay, now spouse 1, the covered one, is above their phase-out range, so spouse 1 gets no deduction. But spouse 2, the non-covered one, still below their $218K threshold, so spouse 2 can still take the full deduction.
Wow, that's a big range where only the non-covered spouse gets the tax break.
Scenario 4. Combined AGI is between $218,000 and $228,000. Spouse 1 still gets no deduction. And now spouse 2, the non-covered one, finally enters their phase-out range. So spouse 2 deduction will be reduced proportionally.
Okay, so now the non-covered spouse starts losing it too, but at a much higher income level.
Scenario 5. Combined AGI is over $228,000. At this point, both phase-out ranges have been exceeded. Neither spouse 1 nor spouse 2 can take a deduction for a traditional IRA contribution.
That breakdown is incredibly helpful. It really shows how intertwined income and workplace plan status are. Let's make it even more real with that Christy example.
Sounds good. So Christy, she's 40, single. She is an active participant in her employer's plan, and her 2023 AGI is $75,000. We need to figure out her maximum IRA deduction.
Okay, single, active participant, 75K AGI. The phase-out for her starts at 73K and ends at 83K, so she's definitely in the phase-out range.
Correct. So first, how far into the range is she? Her AGI, 75K minus the threshold, 73K, is $2,000. The total width of the phase-out range is $10,000. 83K to 73K. So we divide her $2,000 excess by the $10,000 range. That's $2,000, $10,000, 20%. She's 20% of the way through the phase-out range.
Meaning she loses 20% of her potential deduction.
Exactly. The maximum contribution for her age is $6,500. So 20% of $6,500 is $1,300. That's the amount of deduction she loses. We subtract that $1,300 phase-out amount from the maximum $6,500. $6,500 minus $1,300 equals $5,200. That's Christy's allowable deductible IRA contribution for 2023.
Okay, $5,200 deduction. Still pretty good, but not the full amount. Now, the crucial comparison. What if Christy was exactly the same, except she did not participate in an employer plan?
Well, then it's simple. If she didn't participate in a workplace plan, she wouldn't be subject to those AGI limitations at all for the traditional IRA deduction. Her deduction would be the full $6,500 maximum contribution, assuming her earned income was at least that much.
Wow, from $5,200 up to $6,500 just based on whether she had access to a 401k or similar plan. That really highlights how important that factor is.
Okay, let's switch gears to the popular cousin, the Roth IRA. Very different tax treatment, right?
Completely different, yes.
Yeah.
The absolute key distinction with a Roth IRA, contributions are not tax deductible when you make them. You've already paid taxes on after-tax money. So no immediate AGI adjustment for a Roth contribution. Why do people love them so much then?
The magic happens later. With a Roth, the earnings accumulate entirely tax-free. And then if you take qualified distributions in retirement, meaning you meet certain rules, both your original contributions and all the earnings come out completely tax-free forever.
Pay tax now, never pay tax again on the growth or withdrawals. That sounds amazing, especially if you think taxes might be higher in the future. Are there income limits for contributing to a Roth?
Yes, there are income limits for making direct Roth contributions based on your modified AGI. For 2023, the ability to contribute phases out for unmarried folks with MGI between $138,000 and $153,000. For married filing jointly, the phase-out range is $218,000 to $228,000. And for married filing separately, it's again that very restrictive $0 to $10,000 range. So high earners might find themselves phased out of direct Roth contributions.
So if you expect to be in a higher tax bracket in retirement, the Roth is super appealing because locking in today's tax rate and getting tax-free income later is incredibly valuable.
Absolutely. It's a bet on future tax rates, essentially. Or just valuing the certainty of tax-free income in retirement. Now that brings us to the third type, the non-deductible traditional IRA. When does this one come into play?
Right. This feels like the fallback option. Maybe you make too much to deduct a traditional IRA contribution because of the income limits we discussed. Or you make too much to contribute directly to a Roth IRA, but you still want to save in an IRA wrapper.
That's exactly it. It exists so you can still put money into an IRA structure, even if you don't get the upfront deduction. It's also, as you hinted, often the first step in what people call the backdoor Roth IRA strategy, but that's a whole other topic. The key thing is the overall contribution limits still apply. That $6,500 or $7,500 limit is combined across all your IRAs, whether deductible, non-deductible, or Roth. You can't put in extra just by calling it non-deductible.
Right, same total limit. So if you make a non-deductible contribution, you're using after-tax money, like a Roth. How does the tax treatment work then?
Okay, so like the other traditional IRA, the earnings grow tax-deferred. No taxes year to year on the growth. But when you take distributions, it's different from the deductible traditional. The earnings portion is taxable as ordinary income when withdrawn. However, your original non-deductible contributions come out tax-free, because you already paid tax on that money going in. The IRS requires you to keep track of this basis, your after-tax contributions, using Form 8606, so you don't get taxed twice on the same money.
So the contributions come back tax-free, but the growth is taxed. That's the middle ground between the fully taxable traditional withdrawal and the fully tax-free Roth withdrawal. Comparing all three side by side really helps clarify things.
Let's do a quick recap comparing them. Max contribution, all three share the same combined limit. $6,500, $7,500 plus if 50 plus. Upfront deduction, AGI adjustment. Yes for deductible traditional, if eligible. No for non-deductible traditional, no for Roth. Withdrawal of contributions, taxable for deductible traditional, tax-free for non-deductible traditional, tax-free for Roth withdrawal of earnings, taxable for both deductible and non-deductible traditional, tax-free for qualified Roth distributions, taxable for non-qualified Roth earnings.
Okay, here's where it gets really interesting. Understanding those subtle differences can make a world of difference for your long-term financial health. That choice between a tax break now versus tax-free income later, It's a huge strategic decision, right? Depends on where you are now versus where you think you'll be.
Absolutely. It's one of the cornerstone decisions in retirement planning. Okay, let's move into some more specialized adjustments. Health savings accounts, HSAs. These are incredibly popular, and for good reason.
Yes, HSAs, everyone talks about them. What's the main requirement to even have one?
The big one is you must be covered by a high-deductible health insurance plan, HDHP, and generally you can't have other non-HDHP coverage, with some exceptions.
Assuming you have that HDHP, what are the contribution limits for 2023?
For 2023, if you have self-only HDHP coverage, you could contribute up to $3,850.
Huh.
If you have family HDHP coverage, the limit was $7,750. And just like IRAs, there's a catch-up. If you're age 55 or older, you could contribute an additional $1,000.
And those contributions, they're pre-tax, right? Meaning they're an adjustment to AGI.
Exactly. The contributions are fully deductible above the line. That's the first big tax benefit. But HSAs are famous for the triple tax advantage.
Ah, yes, the trifecta. Deductible contributions, tax-free growth, and tax-free withdrawals for medical expenses. Break that down.
You got it. So Advantage 1, contributions are tax deductible or made pre-tax via payroll, reducing your current income tax. Advantage 2, the money inside the HSA grows completely tax-free. No taxes on interest, dividends, or capital gains earned within the account. Advantage 3, withdrawals. Distributions are completely tax-free if used for qualified medical expenses. This includes doctor visits, prescriptions, dental, vision, a very broad list. Even certain insurance premiums like COBRA or Medicare premiums in some cases.
That combination is just unbeatable if you qualify. Are there penalties if you take money out for non-medical reasons?
Yes, definitely. If you take money out before age 65 for something other than a qualified medical expense, that withdrawal is included in your gross income and you get hit with an additional 20% tax penalty. Ouch. After age 65, the penalty goes away. You can take money out for any reason. If it's not for medical expenses, it's just taxed as ordinary income, kind of like a traditional IRA withdrawal. But medical withdrawals remain tax-free. Also important, you can't contribute to an HSA once you're enrolled in Medicare.
Good to know. And quickly, what actually defined a high-deductible health plan in 2023? What were the numbers?
For 2023, the plan needed a minimum annual deductible of $1,500 for self-only coverage, or $3,000 for family coverage. And there was also a maximum annual out-of-pocket limit, including deductibles, copays, etc., but not premiums, of $7,500 for self-only and $15,000 for family coverage.
Okay, great info on HSAs. Now, you mentioned Archer Medical Savings Accounts, MSAs, briefly earlier. These are mostly historical now.
Pretty much, yeah. No new MSAs could be set up after 2007. They were kind of the precursor to HSAs. They were for self-employed folks or employees of very small businesses under 50 employees who also had high deductible plans. HSAs just became more flexible, had higher limits, broader eligibility, so they effectively replaced MSAs. You might still see one if it was set up long ago, but
Yeah.
HSAs are the main player now.
Got it. History lesson noted. Okay, moving expenses. This used to be way more common, but now it's super restricted, isn't it?
Incredibly restricted now, yes.
Yeah.
The 2017 tax law changes basically eliminated this deduction for almost everyone. Now, this adjustment is only for members of the U.S. Armed Forces on active duty who move because of a military order for a permanent change of station. That's it.
So, if you're a civilian moving across the country for a great new job, tough luck on deducting moving costs.
That's the reality now, yes. No deduction for non-military job-related moves. For those qualifying military members, it covers the reasonable costs of moving their household goods and personal belongings, plus travel and lodging costs for them and their family to get to the new station. A vital benefit for them, but very narrow applicability overall.
Understood. Very specific group now. Okay, let's switch to a really important area for many listeners, self-employed tax adjustments. These can be a huge help for entrepreneurs, freelancers, big workers.
Absolutely crucial for them. Being your own boss comes with extra tax burdens, but also some unique deductions to help offset them. Let's start with the deductible part of self-employment tax.
Right. Self-employed people pay both income tax and self-employment tax, which is basically their Social Security and Medicare contributions. How does the deduction work?
So when you calculate your self-employment tax, the good news is you get to deduct 1/2 of what you paid as an adjustment to your gross income. The logic is that in a traditional job, your employer pays half of these payroll taxes, Social Security and Medicare, and you pay the other half. When you're self-employed, you're paying both halves. So this deduction effectively lets you deduct the employer portion putting you on a more level playing field with traditionally employed individuals regarding these specific taxes.
That's a really significant deduction. It directly reduces your AGI just for paying the taxes you're required to pay anyway. Okay, what about self-employed health insurance? That's another big expense.
Huge expense, and thankfully, a potentially huge deduction.
Sure.
Self-employed individuals can generally deduct 100% of the health insurance premiums they pay for themselves, their spouse, and their dependents. There are a couple of conditions. The insurance plan usually needs to be established under the business name or the individual's name, if a sole proprietor, and the deduction can't be more than the net profit from your self-employment business. You can't create a loss with it.
And crucially, this is another above-the-line
Yeah.
adjustment, right? Not an itemized deduction.
Exactly. That makes it much more valuable for many. You don't need to meet the 7.5% AGI threshold like you do for itemized medical expenses. It's a direct reduction to AGI, making health coverage much more affordable tax-wise for the self-employed.
That's fantastic. Okay, the last big one for the self-employed, retirement plan contributions. This is where they can really save for the future and get a big tax break now.
Oh yeah, these plans are incredibly powerful tools. Contributions made by a self-employed person to their own qualified retirement plan, things like SEP IRAs, simple IRAs, solo 401ks, are generally deductible as an adjustment to AGI. We're talking about the non-Roth versions here for the deduction. Just like traditional IRAs, the money grows tax-deferred, and then distributions in retirement are taxed as ordinary income. If they use a Roth option within these plans, like a Roth Solo 401k, then contributions aren't deductible, but qualified distributions are tax-free, mirroring the regular Roth IRA rules.
So what are the main types of these self-employed plans and what kind of contribution limits are we talking about for 2023? They can be pretty generous, right?
It can be very generous. The three main ones. First, the SEP IRA, Simplified Employee Pension. Super easy to set up, great for sole proprietors of small businesses with maybe no employees or just a few. For 2023, the owner could contribute the lesser of 20% of their net adjusted self-employment income, that's net earnings after deducting 1/2 of the SE tax, or a whopping $66,000. $73,500 if age 50 plus with catch-up.
Wow, $66,000. Can you do that Peter example again, the $100 K income?
Sure, Peter has $100,000 in net adjusted self-employment income. His max SEP contribution is 20% of that. So 0.20 times $100,000 equals $20,000. He could contribute and deduct $20,000 in an adjustment to his AGI. Significant tax savings.
Definitely. What about the simple IRA?
Simple IRA, savings incentive match plan for employees, is often used by slightly larger small businesses, up to 100 employees. It usually requires the employer to make either matching contributions or non-elective contributions for employees. For the owner themselves, the 2023 contribution limit was the lesser of 100% of their net adjusted self-employment income, or are $15,500, $19,000 of each 50 plus. So lower limits than a SEP, but good if you have employees.
Okay, and the third one, the solo 401k, this one seems really popular for freelancers or partnerships with just owners.
It is, because it often allows the highest contributions for just the owner. A solo 401k is for businesses with no full-time employees other than the owner and maybe their spouse. It lets you make contributions as both the employee and the employer. As the employee, you could defer up to $22,500 in 2023, $30,000 if 50 plus. Then, as the employer, you could also make a profit-sharing contribution, typically up to 25% of your net adjusted self-employment income. The combined total from both employee and employer contributions couldn't exceed that same overall limit. $66,000 for 2023, $73,500 if 50 plus. So it potentially lets you hit that high limit faster than a SEP might.
That sounds incredibly flexible and powerful for solo entrepreneurs. These self-employed plans are clearly game changers for reducing current tax and saving for retirement.
Absolutely. They are vital tools for the self-employed.
Okay.
Shifting again, let's tackle a couple of the more unique, maybe less frequent adjustments, starting with alimony paid. And you mentioned a critical date here.
Yes, that date again. Let's hammer this home.
It's absolutely crucial. The adjustment, the deduction for alimony paid only applies if the divorce or separation agreement was executed on or before December 31st, 2018. If your agreement was finalized January 1st, 2019 or later, forget it. Alimony is no longer deductible by the payer, and it's no longer taxable income to the recipient. That 2017 tax law fundamentally changed the game.
So for anyone divorced after 2018, this deduction just doesn't exist. But for those with older pre-2019 agreements, it's still in play.
Correct. For those grandfathered agreements, the spouse making the alimony payments can potentially take an above-the-line deduction, and the spouse receiving the payments includes it in their gross income. But even for those older agreements, there are strict rules for the payments to actually qualify as deductible alimony.
Right, you can't just call any payment alimony. What are those conditions?
Okay, the payments must be 1. Required by written divorce separation agreement. 2. Paid in cash or equivalent. No property transfers or services. 3. Not designated in the agreement as something else like child support or property settlement. 4. The spouses can't live in the same household when payments are made if legally separated or divorced. 5. The liability to pay must end upon the death of the recipient's spouse.
That's a specific list. And it's vital to distinguish alimony from child support, right? Tax treatment is totally different.
Completely different. Child support is never deductible by the payer and never taxable to the recipient. And if an agreement requires both, and the payer doesn't pay the full amount due, the payments are considered child support first until that obligation is met. Only the excess counts as alimony. Property settlements are also non-deductible and non-taxable. So understanding the exact nature of the payments defined in that pre-2019 agreement is key.
That date, December 31st, 2018, really is the dividing line for alimony's tax treatment. Okay, last adjustment on our list. Attorney fees paid in certain discrimination and whistleblower cases sounds very specific.
It is very specific, but provides important relief in certain situations. This adjustment is for attorney fees and court costs paid in connection with specific types of lawsuits, namely claims of unlawful discrimination, like age, sex, race discrimination, and certain whistleblower cases under the False Claims Act.
And how much can you deduct? Is it all the legal fees?
There's a limit. The adjustment amount you can take is limited to the amount of the judgment or settlement from that specific case that you included in your gross income for the year. So you can basically deduct the legal fees up to the amount of the award you received and reported as income. You can't deduct fees that exceed the income generated by the lawsuit via this adjustment.
So it effectively helps offset the legal costs against the award itself, making the net recovery closer to what the person actually keeps. It stops the legal fees from eating up the entire taxable award.
Exactly. It prevents the taxpayer from being taxed on money that essentially just went straight to their attorneys for pursuing that specific type of claim. It helps make the remedy more whole for victims of discrimination or whistleblowers.
Wow, okay. We have covered a ton of ground today. From teachers buying supplies, to the maze of IRA rules, the vital deductions for self-employed folks, HSAs, and these unique situations like old alimony agreements and specific legal fees.
We really have. It just shows how many different ways the tax code allows you to reduce that crucial AGI number, each targeting a different situation or policy goal.
This deep dive has really driven home how these adjustments to AGI are such powerful tools. They lower your taxable income right at the start, before you even think about standard versus itemized deductions. It really is about how much income the government sees as taxable in the first place.
And that's the key takeaway. A lower AGI isn't just about paying less tax directly on that income. It ripples through your return. It can unlock credits, reduce phase-outs, make other deductions more valuable. It's foundational. Understanding and maximizing these adjustments is just smart tax strategy.
So, what does this all mean for you listening right now? It means the path to a lower tax bill might not always be about finding new deductions buried in the itemized section. Sometimes the biggest wins are right here, above the line. Are there adjustments you've overlooked? Could tweaking your HSA or IRA contributions dramatically reshape your financial picture this year or next? Take another look. Revisit this deep dive. See which of these powerful tools might apply to your unique situation. Empower yourself with this knowledge. You might be surprised at the savings hiding in plain sight. The tax code feels complex, yeah, but it also holds the keys to keeping more of what you earn.